Was that really a bear market? Welcome to the Shikama Live Show with your host, Shikama. Be sure to interact with this video. That's the only way that we YouTubers get paid. Interacting with the video means clicking the like or dislike, leaving a comment, leaving your opinion, and sharing the video. Oh, and subscribing, of course. That's a big one. So, we just had a downturn and then an upturn in the market. So in this video, we're going to study some past eventful market declines to see what clues they might provide as to what may come next. Traders should continue trade the trend, not their biases. Traders need to be disciplined about managing risk. And this is a stock picker's market. What is a bear market? Google's dictionary defines it as a market in which prices are falling, encouraging selling. Investopedia describes it as a bear market is when a market experiences prolonged price declines. It typically describes a condition in which securities prices fall 20% or more from recent heights and widespread pessimism and negative investor sentiment. And finally, Merriam-Webster defines a bear market as a market in which securities or commodities are persistently declining in value. Now, there are many definitions of a bear market as there are sources. At least a 20% fall from a top to bottom seems to be widely accepted as evidence, as does the term prolonged. The recent decline in the S&P 500 topped at an all-time high, no less than 3,393 on February 19th of 2020, and bottomed at 2,191 on 3/23/2020. Certainly meets the 20% definition, but not so much the prolonged part. I guess the prolonged is often for individual interpretations, but in relation to the stock market, I think few would define prolonged as merely 1 month. Personally, I think if a bear market is a prolonged downtrend, with prolonged being more than 1 month for sure, and time being more important than price. I think many traders use a similar description and the reverse of for a bull market. One thing is for sure, if you would describe the recent downtrend as a bear market, then you must describe the recent uptrend as a bull market. The decline was 35.4% from top to bottom over 23 trading days. The uptrend has been 31.1% over 18 trading days through Friday, April 17th. To summarily dismiss the rally as a bear market rally or a sucker's rally, as I've heard on TV and read in various articles, is, in my view, intellectually dishonest. After all, the common definition for bull market are usually exactly opposite for those for bear markets. Even if the market rolls back over, as many seem to think it will, it would still have been a mistake to have set out this rally. This is the point. It just does not matter what kind of rally it would be, just described as with hindsight. It is a money maker. So was that really a bear market? I think I just proved that the above was more than a fair question at this point. Was that a bear market or not? If your definition is a 20% decline or a strict break of trend, then it was undoubtedly. But not very prolonged, was it? So what do we make of the trend break was only fleeting? Like, is there a 5-second rule? If the index is a question only breaks in the trend for a moment before being recaptured, is it still safe to buy? Let me posit you this. What if someone was on their annual vacation in Antarctica from February 15th to April 18th? When they got home and looked at their index fund, did they see a bear market? What if instead our world traveler dialed up a chart of the S&P 500? He is a long-time investor, so appropriately, he perused the long-term chart. Would he describe what he sees as a bear market, looking at the chart? That's a plausible question, is it not? To further belabor the point, Bloomberg has a list of bear market rallies. The criteria they use, however, makes defining what a bear market rally is pretty easy. Assuming a bear market continues until the index either doubles from a post-peak low or climbs above its pre-bear high. That's a tall bar, the hurdle there. They even list a bear market rally that started on November 24th, 1937. It lasted 223 days and rose 62.2%. If that's a bear market rally, sign me up. So let's take a look at some past declines for clues as to what we might look at, see in the future. 1987, everybody knows. Late August, the market corrected about 9%, then quickly retested the low before rallying about 7%. Then it totally crashed, falling about 34% in less than 3 weeks. It retested the low 6 weeks later, then a new bull market started. The whole thing was over in about 3 months. There are many theories, but no clear consensus as to why this crash happened. 1998. Nobody calls this a bear market, even though the S&P 500 fell 22.4% top to bottom. Now, I suppose the reason nobody called it a bear market is because it only lost 19.4% based on daily closing values. It lasted from mid-July to early October and made a very nice double bottom retest. That was the long-term capital management crisis. LTCM was a massive hedge fund, highly levered. It had to be bailed out by about a dozen or so global banking giants. It sure felt like a bear market to me at the time. I had a big bet. I was over-leveraged. That Creative Computer would skyrocket after completing a spin-off of UBIT. The situation with LTCM put a freeze on all IPOs. And that's when my blood pressure took a leap forward. Finally, eBay, NASDAQ eBay, broke the ice and IPO'd in October. The spin happened, CC did skyrocket. It was my first major stock payday. The late 1990s. The good old days. I've had some spectacular trades like that over the years, but I have also had some spectacular losses. I don't trade that way anymore. I just surf the trend. More reliable outcomes, smaller drawdowns, fewer high blood pressure spikes. 2000, 2002 to 2003. Let's look at the comp for a dramatic effect. A 40% waterfall was the only beginning. Massive rallies followed by beyond massive declines. By the time the dust cleared, the chart showed a 77% decline in about 2.5 years, ending October 2002. No retest of the lowest low. The S&P drug it out, making a triple or even a quadruple bottom over a span of nearly a year. Loss was about 50% for that index. Most agree this crash was caused by bubble valuation of .com stocks, correct? 2007 to 2009, October 2007 to March 2009, top to bottom 57%. There were some great counter trend rallies. There were some double bottoms that worked at least for a while. When it finally bottomed out, no retest. The cause was the 2008 financial crisis. The past bear markets and crashes tell us very little, actually. As frustrating as it is, these past events tell us very little about what it is to come for our current market. Some declines were short, some were long. The total losses are completely different from one from another. Some retested the ultimate lows, others did not. I'm not Kramer. I'm not going to tell you this is the bottom. This is the bottom. Seek the bottom. All were caused from different reasons. If pressed, we would have to say that 1987 is the most similar to 2020 so far. The 1987 crash incurred most of its losses, 34% over just 13 days. The 2020 crash lost 35% in 23 days. 1987 turned out to be the shortest of the four documented here, although I would be hesitant to draw any conclusion from that. We can be sure of one thing only. This time it will be different. I don't know how, but it will be different. Just different. Like all the declines above were different from each other. As a trader, we can navigate this by using simple chart to control our risk. We want to capture the meat of the move. We will never call the turn perfectly. We don't try, right? We'll miss the turn, but catch the majority of the move. Price action is in the final arbiter, not our biases. If you were watching the charts closely in late February, there were multiple signals that would have let you out prior to the majority of the declines. First, the break of support shown on the chart on the horizontal blue in any chart just above 3,200. Next, the breaks of the short-term uptrend in the line anchored at the December 2018 low. Then the fail retest the same uptrend line. The time to re-enter was the index retook the support resistance line above the December 2018 low. So right now we are at a similar place. The upper around 2,900 marks, the index broke down, found supports at 2720, rallied back, then fell and collapsed through the 2720. The index is also becoming short-term extended. The 50 DMA is also in the mix. Going back into cash seems to be advisable at this time. A breakdown below the 2874 would indicate more selling. You don't know if the market's going to reverse if you start selling below that, and that happens all the time. Now, is this a stock picker's market? Judging from what we see in the market is breaking up into several segments of stocks. I think we can expect a more stock picker's market and less of an index-driven market for the time being. We have stocks, which are expected to do even better during times such as Zoom Video, Slack, Amazon, Etsy, and Shopify. These stocks are as high or higher than they were before the crash. These stocks are way more extended than most of the susceptible to pullback. If you're an Amazon investor, fantastic, hold on to it. On the other hand, if you are trading it, consider taking some profits. That's just prudent risk management at this time. Then we have stocks where the peers investors expect to do well in the medical accelerated business migration to the cloud. Alteryx, Splunk being examples. These two have put in double bottoms and are consolidating nicely over the 200 DMA. Then we have banks, hotel, casinos, energy names, and many others that are languishing. JP Morgan, Hilton, MGM being examples. It is possible that the last group has the most upside simply because so much negativity is already priced in. But for now, they are not doing anything. Defining a bull market is just human nature. We like to label things, but the truth is that 20% is arbitrary and doesn't really mean anything. Few bull markets go straight up, and few bear markets go straight down. There are few parallels between past bear markets. There are a few clues as to the new one might play out, or even as to or has it already played out. Money can be made on significant rallies during bear markets. And if you really, if the rally turns up to a bull market, you won't know it all until much later. If you're a trader, follow the trends and exit when the trend becomes less clear. Long-term investors should stick to their plan if they're on solid ground. Stock picking is more important than it has been in years. The most upside may come from those with the most uncertainty, but they're staying down for a reason. Best to stick with those that have solid but less extended charts. If you do want to play banks, energy, and hospitality, keep a tight stop. Enter all trades with a plan and stay disciplined. Was this a correction? Is it a correction? Is it over? That's the real question right here.